Hello again, and welcome to the 365 Retirement Podcast with the team at Rubino & Lang Wealth Partners. John Conley is with us today. My name is Randy Cook. And each week as we go through some of the things that are going on out there in the financial news, and there's a lot to talk about once again today. John, how are you doing?
I'm doing well, Randy. How are things with you?
Pretty good, pretty good. We are currently making our way through the month of August here. We're not too far away from school starting and such like that. But I realize that, as people listen to podcasts, they might hit something, and we recorded a couple of months ago. But what we're going to talk about today is market pullbacks, because we just experienced one, and this is something that you're going to have to deal with regularly if you have money in the market. And the first thing we all want to know is why these things happen, what we can do about it, no matter what happens, whether it's, while we're getting ready to go into retirement or we're in retirement. So we're going to talk about that today. And John, what are the reactions? Do you get a lot of calls at Rubino & Lang Wealth Partners when the market goes down 1,000 points or something like that? Is there worry amongst the people that you've built plans for already, or you get a lot of new calls and people say, oh, I better do something? What's the reaction when the market does one of these dipsy doodles?
It's a great question. I think with our existing clients who have been clients of ours for a while, they understand that we have them positioned in such a way that is in line with their risk tolerance, and that the portfolios and the models that we are using is really built to have diversification and balance, and should be able to withstand some of these market corrections that we're seeing. But there are calls from maybe a prospect or someone who's very concerned, or friends of ours that will ask questions of, hey, what's going on? And there's panic, and we see that, with some individuals, but our clients have seen these type of cycles before, know how we operate and how we're going to handle them. So the panic is far less.
So these things happen. It could be a report. Not recently we had an inflation report. We had an unemployment report. There can be an earnings report, these things, and the market goes down. And maybe it goes down significantly. The question is this a one-time event? Is this something that is the start of something bigger? And I've got a cut that I'm going to play here for you from one of the voices on CNBC. His name is Scott Zelnicker, and he kind of puts this whole thing in perspective. If you've got money in the market, this is what you kind of got to deal with.
The markets haven't had a pullback of more than 5% in over a year. That's not normal. 10% pullbacks are normal in a given year. History shows that a 10% is once a year, 5% is at least twice a year.
All right. So that's probably good information to know that this is the nature of things. And if you've got money in a market and it's a 401k even, you've got to kind of come to grips with that, don't you, John?
Yeah, like he said, there's, a 5% pullback you'll see maybe twice a year, maybe a 10% pullback at least once a year. And so what that tells you is that this is kind of a normal occurrence that you can see in any type of market cycle. Now, what drove this particular pullback or correction, so to say, was that the jobs report that came out showed that, that the unemployment had grew and jobs have slowed down. Mm-hmm. And that put fear or some panic into individuals that maybe the Fed Reserve wasn't really going to hit that soft landing that everyone was predicting, and that maybe a recession was on the horizon, or maybe we could be even possibly in a recession. Mm-hmm. Keep in mind, the Fed Reserve has never raised interest rates that did not result in some form of a recession. So far, we haven't seen it. I don't think we're in a recession. I don't think we're going to hit that recession. But that is what set the tone of the pullback, right? And on top of it, you got to remember, we've had a really good start to the year. The first 6 months were really solid. You look at the tech industry, very solid year. There was bound to be some form of a pullback or a correction at some point in time this year. And this is normal during an election year as well.
We're also coming up on two of the most volatile months of the year, coming up on September and October, and the fall is usually kind of up and down. That's kind of been the history of the stock market. So then the next question we're going to go into is, what do we all do about it? If you're getting closer to retirement, it becomes very important to, de-risk your portfolio. If you're 40 years old or 30 years old, it's a whole different ballgame. This is Scott Zelnicker. He's also one of those voices on CNBC talking about being defensive?
Right now, you want something that's a bit recession-proof because the bond market, with the moves that we're seeing, they're screaming at us right now to tell us that they think we're looking at a recession. So this sort of bodes for a bit more of a defensive posture until we can really see if this is a temporary storm or bumpy landing, so to speak, or if it is indeed a harder landing.
Okay, so that makes sense. What, in your opinion, let's define what is a defensive position? And is this something that you continue? Is this something that's a temporary kind of a fix? How do you see that?
When you think about where are we at today and what are we predicting moving forward for the rest of this year and into next year, I don't think we are in a recession. I think there's a lot of positives out there. I think this most recent jobs report will actually force the Fed Reserve to lower interest rates come this September. I think that easing of interest rates will also be a positive to the market. But like in any case, you always want to make sure that when you sit down and we have a client, we want to make sure that we assess you correctly, that you're in the appropriate risk tolerance, and that your portfolio reflects the type of level of risk that you want. Not necessarily just go into a defensive position, but making sure that you have the appropriate risk tolerance and that we can withstand the ebbs and flows of the markets during these times. And like you mentioned, look at it and say, is this something that's going to be a short term? Is this a long term situation? When we're having quarterly reviews with our clients, we're making changes to the portfolio based on current market conditions. So our clients most times we've recently spoke with most of them because we're having those quarterly reviews and they know what to expect. But obviously, if we felt like this was going to be something that was a long term, we would dial down their risk tolerance, maybe introduce some structured notes, more bond position, maybe principal protected accounts. But at this point in time, we think this is a short-term situation, not a long-term.
So you bring up bonds, and that is what I want to talk about next. There's two things that people do on their own, the DIYers out there, that will say, okay, I'm going to get out of the way of this crazy market right now, at least for a while. It makes you a market timer, but think about that too. But cash and bonds. I'm going to move more to cash and sit this one out on the sidelines until I think it's time to go back in, or I'm going to go to bonds because it's always been stocks for growth, bonds for protection. Talk to me about both those alternatives for people.
Well, you think about it. Let's say someone the other day, they see that the market was correcting or it was a volatile day in the market. Now, a do-it-yourselfer or someone who doesn't have a financial advisor may have just reacted to that, a knee-jerk reaction, and gone into cash. And all of a sudden, the next day, the market kind of rebounded a big chunk of what it lost the day before. And then the next day, it goes up again, and you're still sitting in cash. So you took the downside, but you absolutely missed most of the recovery or the bounce back, right? So you want to make sure that you have the discipline during these times to make sure that you are properly invested, that you have enough money that's fully vested or some money in cash to take advantage of maybe some growth opportunities that are there right now. But maybe bonds, like you mentioned, is another alternative. Look, in 2022, the Fed Reserve was raising interest rates. And as interest rates rise, the value of bonds will decrease, okay? And we saw in 2023, bonds didn't really perform that well. First half of this year, bonds weren't doing so great. But as the Fed Reserve starts to ease the interest rates and start lowering the interest rate, we're excited to see that bonds will start to recover and be a big part of your moderate portfolio, even part of your diversification.
What about the idea of these proportions? You hear about the 60-40 portfolio, 60% stocks, 40% bonds. If you are getting close to retirement and maybe you want to flip that and say, I'll have 40% of my money that's in the market and I'll have 60% of my money that's out of the market that's not going to be affected by that. Then if the market goes down 20%, only 40% of your money is affected. That means you're down 20%. You could probably make it back from that in not a hard period of time. And so does that come into the conversation when you're sitting down talking to somebody who's kind of on the edge of retirement?
Yeah, as you get closer to retirement, the goal is that you become a little less risky in your portfolio. You lower your risk tolerance. But each individual is different. Everyone's scenario is different. Let's say in 2022, as we're reducing our risk because you're getting closer to retirement, someone may say, oh, I'm going to start buying more bonds because I want to de-risk my portfolio. I want to lower my risk. But in 2022, bonds weren't performing well because of the rise in interest rates. So that could be a bad move for that individual, or they weren't protecting it in the way that they thought they were going to protect it. The key is to making sure that you sit down with a financial advisor, come up with a plan, and making sure that you understand how your portfolio reacts in different market cycles and climates, and making sure that we're adjusting it accordingly based on current conditions and projected conditions.
Well, the facts are that we're going to go through these things regularly. When we're in our working years, we're going through our retirement years. These 1,000-point drops or corrections or bear markets, all these things are going to happen. And if you're getting close to retirement and it bothers you, well, that's a sign. You don't want this happening during your working years. You don't want it happening in your retirement years. So it's time to build a strategy for it. We can talk about de-risking and getting you out of that market. Enough for growth, but not so much that it would hurt you if these things happen. Let's talk through it. Give us a look on our website, which is 365retirement.com. Up in the upper right-hand corner, there's a place that says Talk to an Advisor. You can click on that and talk to John and the other members of the team at Rubino and Lang Wealth Partners. We encourage you to like and subscribe so when you know when the new videos come out, and we appreciate you listening. We'll see you next time.
Ryan Marston and John Conley are investment advisor representatives of Brookstone Wealth Advisors, LLC, a registered investment advisor. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. To find out if Sam Lang is licensed in your state, please call 617-630-8787. Rubino and Lang Wealth Partners is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Rubino and Lang Insurance Agency, LLC, Massachusetts Insurance License number 1783398.